Do you think that the people who are feeling that this part of the market would hold up, at what point do they start to experience losses if the environment were to turn even further and if rates stay higher for longer?
They might, but I think right now, actually, credit still looks relatively cheap. If you go back to where we were in 2018, 19, we're much wider on a spread base. You're seeing VIX come down. VIX tends to be somewhat correlated with CDS spreads and credit spreads in general. So I think there's room for credit spreads to tighten actually further from here. When I look at the high yield market over the last 10 years, it has changed dramatically in who's issuing. So the overall quality is much better. The companies are public companies, you tend to know them. They've got a lot of research being done on them, not just on the debt side, but also the equity side. So I think it's a much safer market. And I think people have actually been a little bit reluctant, even with those flows you talked about, to heavily invest. So if anything, I think you're going to see spreads do reasonably well over the next 3 to 6 months. And credit's very well positioned for any sort of recession risk if we get it. And if we don't get it, there's even more room to tighten.
Do you feel as sanguine about leveraged loans here? I know they're floating rate, but they can really be, we've seen them hit very recently. Do you think that this is the time to get in?
No, I'd be much more cautious in there because, again, I think that's where the smaller deals kind of found their way. To me, CLOs were the big driver of leverage loans. CLO money came in. Your job as an asset manager, if you're running CLOs, is to invest it so you can go and raise a new CLO. So I think there was probably less work done on some of those credits. They tend to have more private credits. Some don't have all the financial information readily available to everyone. So if there are problems, it's going to occur there. But having said that, I think what we're going to see is CLOs act like bankers of the past, where bankers used to extend and pretend, right? So they didn't force companies into bankruptcy. They like to extend, change the terms a little bit. So I think the CLO market's very well positioned to negotiate with these leverage loans. So I think the default cycle, if it comes, will be pushed off down the road just because of that flexibility.